Nothing. Nothing but. Nothing but net.
Welcome to Nothing But Net, the podcast for triple net commercial real estate investing. Before we get into the meat of today's show, let's recap on why there's so much interest and buzz around net properties. Triple net properties are commercial real estate investments where the tenants, usually brand name corporations, pay you rent every month. Can you say mailbox money? In addition, they pay the real estate taxes, insurance, and maintenance for the property. No toilets, termites, or taxes. What's not to like? You can remember what net or triple net stands for by using TIM, taxes, insurance, and maintenance. With triple net properties, there's lower risk income and cash flow because rents are guaranteed by strong credit tenants. Preservation of wealth, because rent increases and property appreciation are bulwarks against inflation and a great store of value. Tax efficiency. The government wants investment in commercial real estate, so they provide inducements through depreciation and deductions which shelter income from taxation. Tax deferral, which gives potential for infinite tax deferral with 1031 exchanges, which are very popular in the triple net space. Triple net properties are a tangible asset, and as Mark Twain once said, buy land. They ain't making any more of it. Pride of ownership. You can walk into a beautiful building, be it a restaurant, drugstore, grab a coffee or some shampoo and say to yourself, I own this. Lastly, it's great for legacy or estate building. You can pass it down to your heirs or gift it to your favorite charity or cause. Once again, thank you for tuning in to Nothing But Net, the podcast for triple net commercial real estate investing. Let's get to the interview. Today on the Nothing But Net podcast, we are going to try to answer a few questions. Where do you go in the world to obtain a safe haven investment in times of global economic storms? How do you avoid stock market volatility, where one tweet from a president can send your investments crashing? What investment alternative has produced the most stable returns over long periods of time, creating value and preserving wealth? How can you achieve consistent monthly income and cash flow? Now I'd like to introduce my co-host, Michael Flight, the man with the answers, the experience, and the one that's going to be sharing his knowledge with us today. Michael, can you elaborate a little bit on the questions that we just went over coming into this interview?
Hey, thank you, Adam. I really appreciate the introduction. Looking forward to talking a little bit about real estate. I think the title of the podcast is Why Real Estate? To answer all these questions, I go back to real estate has always been the number one generator of wealth. You can see it in large families, royalty. What do they all have? Family offices. If you look at the Forbes 500 list and take a look at what those people have, they might have made their money originally like the Waltons for Walmart, but most of them go into real estate to not only preserve their wealth, but also protect against inflation and also as steady cash flow in case the businesses that they're invested in have an up year or a down year. So they do that, and real estate has always been the number one generator of wealth since humans turned from a nomadic existence, settling down and staying in one place. Millionaire Andrew Carnegie famously said, Adam, that 90% of millionaires got their wealth by investing in real estate. And then one of the guys that I just found out about a few years ago, but I really love most of his books, Gary Keller, best-selling author, millionaire real estate investor. Mm-hmm. His quote is, no other investment has such a consistent and positive effect on the average person's net worth as real estate ownership. And then I love to always quote, and I'm not sure if it's accurate that he was the one that said it originally, but Mark Twain said, invest in land, they're not making it anymore. I always like to put a caveat on that they are still making it in volcanic islands like Hawaii. And if you go to Dubai, they're making it out in the middle of the ocean by dumping a lot of sand from the desert. So, but for the most part, you've got an asset with intrinsic value. So that's why we really like it. And I personally like it. I got to say, real estate, is the proven king of wealth creation for thousands of years. real estate is a safe haven and always has been a safe haven in times of economic turmoil. So as we're recording this, there's not only pandemics, there's fires, there's riots, there's all kinds of dislocation, but real estate is there. It retains its value. The type of properties that we invest in have really held their value during this time. Real estate has, as I said before, tangible and intrinsic value. It is a hard asset, so it's very similar to gold and other commodities, but unlike those commodities, real estate is a cash flowing asset. So you can get money. You can also borrow against real estate, which is just a phenomenal opportunity. So you can, let's say you're going to go buy a building. If the building is worth $100,000, a bank might loan you up to 75% of the value. So you can control a lot more real estate than you could control in a stock market portfolio, in a portfolio of commodities, or in a cryptocurrency portfolio. What we really like is commercial real estate investments create recurring monthly income. I'm going to say it again, real estate is the safest investment in up and down times, and a big thing that many wealthy families, and what I would recommend to anybody, is real estate has traditionally been an excellent hedge against inflation. And the way they're printing money all over the world these days, you might want to consider that.
Yeah, absolutely. Completely agree, especially with that last statement. It's really interesting to see what's happening here as we move into the years 2020 and beyond. And I would say, to me, reemphasize why I also believe real estate is an excellent investment. You've been in this industry for more than 35 years, so you've really seen it from top to bottom. You've seen the different sectors within real estate. And so, in your opinion, what's different about commercial compared to other types of real estate? Because I know a lot of individuals out there, when they first hear and think real estate, they just think, buying, selling, and renting residential homes.
Yeah, you have an excellent point there, because everybody, I don't want to say everybody, but when I tell anybody, if I'm at a cocktail party or I'm at a business meetup or something, they say, what do you do? I said, I'm in commercial real estate investment. They say, oh, like selling houses. And, and I'm like, no. And so then I explain a little bit more. So we happen to specialize in a very specific area of commercial real estate investment. My background has traditionally been with retail real estate investment. That is shopping centers, that is single tenant, triple net stores, like you would see a Walgreens or a McDonald's or a single tenant, Starbucks on the corner. And so that's the type of investing that we do. And really why we decided, you and I together decided to name the podcast Nothing But Net, is we specialize in commercial real estate that has very specific contractual agreements known as net leases. And so the net lease is the tenant agrees to occupy and utilize and take a building or the space from the landlord. They do a contract called a lease, and they are also called triple net leases, or they're called NNN, which is capital N, 3 N's in a row. Mm-hmm. And specifically, like I said, what we like to do right now is single tenant triple net leases, which are single buildings. But let me explain to you a little bit about what the whole net thing is all involved there. Nets are basically the expenses that are paid by the tenant. So in an apartment building, you would typically lease the apartment to the tenant, and then the landlord will be responsible for paying the taxes and the insurance and maintaining the building and all the rest of it. And so that is called a gross lease. Well, the type of leases that we do, you don't have to deal with tenants, you don't have to deal with toilets, and you don't have to deal with taxes, because what we do is a net lease, a single net lease, is where the tenant pays the rent, plus they pay the real estate taxes for the property. In a double net lease or an NN lease, the tenant pays the regular rent for the property. So we might agree to pay, the tenant might agree to pay $1,000 a month, and then they pay all the real estate taxes, and plus they pay the property insurance. And in commercial real estate, the property insurance includes the insurance for the building. So they're insuring your building. They insure the contents of their inside of their store, which is a separate insurance policy. but the building insurance also includes liability insurance, so that if somebody walks into the parking lot, or if somebody walks into their store, or if somebody trips and falls, on a sidewalk or something like that, the tenant pays for all that insurance. So that's really great, because the tenant is not only paying your taxes and your insurance, so that eliminates some of the guesswork in where you think your income is going to come in. But the next one is the net, or triple net lease, or NNN lease. And that is where the tenant pays the base rent. So they pay, again, with our example, they're paying $1,000 a month, plus they're paying the real estate taxes. So the easiest thing to envision is if it's Starbucks and it's a single building and you're driving up and you're going to get a coffee, in most cases, that Starbucks is paying their monthly rent. They're paying for all the property taxes for not only that building, but also the property taxes for the land, parking lot, and drive-through. They're paying for all the insurance involved with that building, whether it's fire insurance, whether it's earthquake insurance, whether it's general property insurance like plate glass windows. And then they're paying for the liability insurance in case something happens where a person gets hurt, or just something out of the ordinary. So that's all the insurance for the building. And then they're also paying for the maintenance costs. So they're paying to maintain that building. And a pure triple net lease, the tenant, he fixes the roof, the tenant fixes the building, the tenant does anything on the interior, the tenant takes care of the landscaping, the tenant sweeps the parking lot. In case you live in northern climates, the tenant pays for the snow plowing. So the really great thing is that in a triple net lease, the tenant pays you rent, plus pays for everything and takes care of everything. The way to remember this is we use the acronym TIM, which stands for taxes, insurance, and maintenance, to remember what the tenant pays in triple net.
Awesome. Well, that's really good to know, Michael. Thank you for going into the details on each of the different types of net leases. That really helps. Sounds like triple net is the best way to go if you're a property owner. So that's cool. Could you elaborate a little bit more on what the advantages are of a triple net lease?
Well, the advantages are that the property owner, you can know that they're going to get a set rent and that there's not going to be fluctuating expenses, so that they're not going to have to worry that if it snows really hard in Chicago, that they're going to get hit with a $10,000 snow bill. They know that the tenant is going to have to pay that. It just creates a stable, predictable, yearly thing. So that your net operating income isn't going to increase or decrease with, and it's especially good with real estate taxes too, because there's some jurisdictions that keep jacking up the real estate taxes.
Right. And, especially in regards to what you just said about the real estate taxes, I'm wondering, at what point does a tenant feel as though this is the best option for them in regards to leasing?
Tenants, like to, in a lot of situations, would prefer to lock in longer term leases. And so with this type of option, they can lock in a long-term lease and they can get a landlord, because especially if they want to control their costs and they like the real estate location and they're going to spend a lot of money advertising and building up that location, they want to know that they're going to be there. And so this is a way that both the landlord and the tenant can do a long-term lease. And then they know that they can control the quality of their services. They know that they're responsible for getting things exactly the way they want them. And they know that they can, protest the real estate taxes and do that, because sometimes, landlords are a little bit lazy with doing that. The other thing is lease expenses are 100% deductible. These type, especially the triple net single tenant leases, give the tenant visibility. They give them access and parking. And it can really, if you're a consumer brand, it can help further your visibility in the marketplace. It kind of serves as a billboard for brand awareness. I believe I said it before, but a tenant, if they're doing this type of leases, they know that they're locked in, and then they can go and put a lot of their capital into expanding either their store, their operation, or whatever they're doing in particular.
Okay, nice. Yeah, I never thought of it from that longevity standpoint. Are those the only types of tenants that do triple net leases?
Well, it's the most common. I'm not sure if it started there, but it seems that that's where the majority of them were. But right now, triple net leases, especially single tenant triple net leases, there's a lot of activity with other types of products. So, for example, single tenant office buildings, you can see them right now. There's a number of properties on the market for with Amazon in them or Google in them. They'll lease the whole building and somebody will come in and buy it. Another thing that's very popular, it's usually more popular with larger institutions and real estate investment trusts. They will do what's called a sale lease agreement. So they'll go in and buy an industrial plant or a group of industrial plants from a particular owner. Let's say it was a widget manufacturer and they had a plant in Wisconsin, they had another plant in Florida, and they had another plant in California. And so these larger institutional investors will go in and say, how would you like to free up the capital that you've got in this real estate? And we'll do what's called a sale leaseback, where we'll do a long-term lease with you. You will have all the ownership responsibilities like you had when you were owning the building. You just won't own the building. We'll give you all that capital. So it's a kind of a way for them to unlock the capital that's just kind of sitting there on their balance sheet. And then what happens is that they do the long-term lease. They can then fully deduct all the lease expenses. So before, they might, even if they had a mortgage on the property, they could not deduct they couldn't deduct the principal payments or anything like that. So it really is a way for them to shore up their balance sheets. And it's been really popular right now because during the pandemic, there was operating companies that were actually closed in a number of different, situations. And they couldn't, the banks were kind of frozen. The banks weren't out lending money. And the only one that was out there throwing money around was the government. But there was some of these companies, which were fairly large companies, could tap the assets on their balance sheet, and they could do a sale leaseback. They get the money that they need in times of distress. So they've freed that capital up so that they can invest it in basically surviving. So those are some of the tenants that are doing things. And then one of the coolest triple net deals that I've heard of, I don't know how it's performing right now, but Blackstone and another real estate investment trust teamed up to buy the assets of, I'm trying to think of what it is, but it's one of the major casino companies in Las Vegas, the ones that I think they own Caesar's Palace and it was MGM Resorts. So okay. Blackstone teamed up with MGM Resorts. They created their own real estate investment trust, and then they did triple net leases with all those casinos out there. And so the casino, basically MGM operates the casinos, does everything that they were doing before, but they don't own the properties anymore. The properties are triple net leased to this real estate investment trust and Blackstone.
Just real quick, when did that deal take place?
That happened, I believe, at the end of 2019. It was a super huge deal. So I think it was in the billions of dollars.
Wow. Well, that's all the time we have today for Nothing But Net. The topic of today's discussion was why real estate. If you just tuned in and joined us for the first time today as well, we should also remind you, go ahead and check out episode 1. It gives a full background on what has inspired the creation of this podcast. We're really happy to have you here. Make sure you like, subscribe, and rate the show if you haven't already. Michael, any closing words?
I just want to thank you very much for putting this together, Adam. Really excited. As you can see, I never get bored talking about real estate, square feet, net charges, blah, blah, blah. Thank you very much for putting this together for us.
Absolutely. Guys, once again, thank you for tuning in to the Nothing But Net podcast. We'll catch you in the next episode. Thank you once again for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. If you enjoyed what you heard today, one last friendly reminder to like, share, subscribe, or leave a review for us. It really helps a ton with the show's visibility. For the Nothing But Net team, I'm Adam Carswell. Take care. Nothing but net. The Nothing But Net podcast is not intended to provide legal, tax counsel, or accounting advice. Adam Carswell, Michael Flight, Concordia Realty Corporation, Liberty Real Estate Fund, LLC, and their affiliates do not provide tax, legal, or accounting advice or the worthiness and promotion of any particular investment. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction or undertaking. We highly encourage individuals and investors to seek the counsel of a qualified attorney as well as seek the counsel of a tax professional or certified public accountant to determine if there are any potential tax liabilities or consequences as a result of anything contained herein. All listeners of this podcast or video should understand that there are no guarantees of any success, outcome, or profitability of any transaction or undertaking, expressed or implied, and will not be liable for any financial or other losses or damages incurred as a result of any undertaking. Go to nothingbutnet.us for a complete set of disclosures. Thank you.